The Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, it's been an interesting turn of events here in the metals market, especially over the second half of the week, but we were chatting before the show that both Eric and I independently feel a little bit of a difference in the trading in the beginning part of the week. On the heels of the FOMC statement Wednesday, gold has popped back above 1,200 and is clinging to 1,200 through the close here on Friday, closing above 1,200. Silver back above 16. Kind of had a funky sideways trading action here on Friday. Did trade on Thursday almost as high as 16.50, but silver also is back above 16. And it's interesting, I was chatting with Eric before we started recording. Typically, anytime there's an FOMC statement or the Fed chairman, whether it's Bernanke or now Yellen, coming to the podium to speak, typically we don't want to be extra long on the metals because time and again over the last 5 years you've just seen them hammered for the next 48 hours afterwards. And for one of the first times on Wednesday morning at SD Bullion, we made sure all of our mint orders were in prior to the Fed statement at 2 p.m. Eastern, because you could just sense the trading was a little bit different and it didn't look like they were going to be smashed afterwards like is typically the case. And that proved to be the case, didn't it, Eric?
It did, and we have seen all throughout this week and extending back last week that there's been less focus on trying to attack gold by the cartel, but rather kick around silver in the hopes of managing the gold trade. We've seen that even today. Going into the London PM VIX, which is the most important benchmark for the pricing of silver and gold worldwide, it impacts the sale price paid for miners delivering into the refining systems. It impacts the press coverage worldwide when it comes to reporting on, there wasn't that big of a move in silver to the upside, and it actually went down going into the PM VIX, so that becomes the storyline as opposed to what is even more important when it comes to market signal intelligence value, so to speak, because the U-turn that silver did today speaks to the fact that the paper boys out there are interested in grabbing whatever the cartel delivers up in terms of price action to the downside because it gives them the benefit of buying cheaper silver. So we've seen this pattern over and over again, and it speaks to the thesis that I advanced even back on May 30th in terms of what has shifted in the market sentiment. There are more people that are aware that there's a growing probability of a silver shortage at the back end of this year, and that has resulted because of all of the damage that has been done in this cyclical 4-year bear market suppression that the cartels operated to the point where the average cost of production is somewhere around maybe $21, $22 or so, a little bit lower now because oil prices are lower for silver. But the prices here are having mine closures and mines going on care and maintenance and less incentive for new discoveries to begin to move through the process of discovery to ultimate mining operation. So we're now seeing the impact of that, and even as I've noted a couple of times, a bullion bank participant like HSBC is coming out and saying that we're going to have an 8% supply deficit by the end of the year. So it doesn't. When you have that kind of stuff going on in the conventional finance world, it's no surprise to see even the paper trader jockeys of the conventional finance world goofing off and playing around in COMEX and LBMA and accumulating the dips now. It all goes to show that we did bottom in November, and that's likely the very bottom for this whole bear period that we've been in, and that we're struggling to move to the upside because we have constant capping. But like I said back on May 30th, June is going to surprise people to the upside. 16 on silver, pretty much held with the exception of intraday less than 24-hour periods where the cartel was able to knock it down below 16 by 10, 12% or something, which is pretty much trivial. And here we are, even after the attack this morning over at the LBMA and COMEX, we're above 16 still. So, and I think the thesis still holds that later this month we're going to continue to drift higher, and by July will begin to target, and I should stress early July, will begin to target that 1850 area where when we get over that, people are going to recognize, gee, the bull market is back and accumulation is back.
That sure would be nice. So, Eric, you're predicting more of a drifting higher in silver, particularly towards that 1850 level, and not a short squeeze like some, such as Bull Pulney, are predicting?
Well, I think, we will see spikes upward, and when we do pass 1850 in particular, it'll be a relatively faster appreciation between 1850 and, say, testing of 22, but the road to 1850 will probably see exactly what we're seeing right now. I mean, yesterday we got almost as high as 1650, and then the cartel came in smashed after London LBMA fix was done. And, we overnight went down, and some people were even beginning to post things all over the net saying, well, from a technical perspective, did silver just fail its breakout, because gold was doing all right. Like we were discussing a moment ago, gold actually has not been the target of as much aggressive capping as we're seeing in silver right now. Anyway, the bottom line is I think we're going to go higher. The silver and gold tradition, particularly when it comes to the media framing, has always been, there's a summer doldrums and we're going to have weak summer pricing and all that. And frankly, given how long the bear cycle was leading up to November of last year, and given the huge demand coming out of China and India, and it being completely underreported in Western media, I think the fundamental factors are here to have a much stronger summer than anyone expects, other than some folk in the precious metal space itself.
Well, the other story we want to cover today is Greece, and their bank runs have been escalating really as the week progresses. And a question we chatted a bit about before the show, but I wanted to ask you, Eric. The Tylers over at Zero Hedge, at least one of them that's been covering Greece, has been theorizing that the ECB has been intentionally trying to trigger Greek bank runs to push Greek banks to the brink in order to accept the ECB and the Troika's demands. My personal thought, as we were kind of commenting, is that, yeah, sure, that might be nice for Greece, but personally, I think they'd rather just suddenly bail in all the Greek depositors rather than the risk of triggering contagion to some of those other European nations, Portugal, Italy, Spain, and so forth. So what's your thoughts on that theory Zero Hedge has been pushing, that the ECB has been trying to trigger bank runs in Greece?
Before we even answer that question, we need to put into context the fact that there are at least 3 people who write under the pen name Tyler Durden over at Zero Hedge. And at least from the perspective of the number of stories that have been published over the course of this year, an even more frequent theme that they have been putting out is that the biggest fear that the ECB has is contagion to Spain and Italy in particular, and secondarily to Portugal, in terms of, if there are bank runs in Greece and Greece does a Brexit or just comes close, that would inspire contagion. And I think that thesis is actually largely correct and far more powerful and important than the recent thesis that they're putting out, particularly this week, where this particular Tyler is claiming that, even back in February we said that X, Y, and Z is going to happen, and therefore the possibility of the ECB trying to run some kind of a strategy to destabilize the Greek banking system, to throw the Greek negotiating positions on their back, and basically giving the ECB and the Troika overall the power to dictate the terms of this negotiation. I think that thesis largely is incorrect because, frankly, it contradicts the other thesis that some other Tyler Durden has been putting out that's even more important. I mean, it's really not in the best interests of the ECB to start throwing around bombs and trying to make the Greek system completely fall apart just because they would thereafter have a stronger negotiating system, a negotiating platform. The logic trained to that just doesn't make a heck of a lot of sense because probable consequences, not even unintended consequences, the probable consequences of that kind of bombastic strategy could be very damaging to the European Union and the Eurozone altogether, because it could further up the odds of contagion. So I don't buy the thesis that they're talking about. The bottom line with Greece is that the negotiations have been, in the nearest of terms, focused on the 7.8 billion euro tranche of what I call vendor financing that would be liberated and given to Greece were they to up value-added taxes and reduce pension payments first and foremost. That's the main negotiating plank that the ECB is putting towards Greece as a demand. And I don't think that that's going to work. I think that we will have a technical default declared at the end of this month, maybe sooner, and through the period of July, that's when things are going to start becoming interesting, where I think the highest probability scenario, and I base this mostly on just reading the number of comments that come out of all the various players and the press coverage and so forth, that you can kind of get a sense as to where at least most of the thinking on both sides are falling into place. And it looks like the highest probability scenario is that a technical default will be declared, that the ECB will permit some kind of a way in which Greece will be able to at least manufacture some liquidity, and there is a possibility that Greece may be permitted to do exactly what Ireland was permitted to do back in 2011. And a lot of people don't remember this, but Ireland was able to print its own bonds, to issue its own bonds denominated in the euro, which essentially was expanding their own domestic money supply, kind of, sort of, like printing their own euro. It's not exactly, but it nonetheless allowed to liquidate their banking, give more liquidity to their banking system, because that issuance of credit became further collateral within the banking system in Ireland, and then elevated their banks and prevented a kind of systemic crisis spinning out of control. So I suspect that that will be permitted to be done, and that it will allow Greece to remain in the Eurozone for a period of time without barbecuing, the use of the euro, and thereafter creating greater odds of contagion impacting Italy and Spain. And as a parallel possibility to this, and which has been discussed quite frequently in the Greek press, the issuance of some kind of an IOU-based parallel currency may also be introduced. We saw something like that in California a few years back when there was a debt crisis, and the taxation issue in Sacramento was not able to come to terms with the Democrats and Republicans. There was a complete standstill, and they ended up having to issue IOUs to pension holders and the CalPERS system and government employees and so forth. And those IOUs actually traded independent of the people receiving them as their own currency too. It was almost like a script. So I think that that's going to happen in Greece as well. I don't know how quickly these two things could surface, but the earliest would be July, because I think a technical default at this point is almost a foregone conclusion, because there's been no progress in the ability to come to terms that both sides can agree. And that's going to surprise a lot of people too in the precious metals and alternative asset space, because generally speaking, most people have been thinking about this in either-or binary terms, that either there's a Grexit or that there's some kind of resolution. And frankly, we're going to go through this kind of like eye of the storm period, before you even have the possibility of full-blown Grexit, I suspect. And that July, August, September will be the defining window in which that kind of eye of the storm hybrid scenario unfolds. And on top of everything else, we also have the possibility of the derivatives positions, like the credit default swaps that are held by banking institutions on Greek debt, will probably be nullified, because back in the day when Cyprus had their quote-unquote technical default, the grand poobahs of the monetary system and the IMF basically said, well, whatever, this isn't a full-blown commercial default, it's a technical default, and therefore you don't have to call claims against the counterparties on this, and instant presto, there was no derivatives domino chain implosion. Where obviously we were dealing with a lot smaller amount of debt at that point. The Cypriot banking system problem was on the order of about 11, $12 billion, if memory serves, whereas this Greek scenario is involving more than 300 billion euros. So it is qualitatively quite different, but nonetheless, I still think they're going to probably declare a lot of these derivative positions null and void. So, whatever they need to do to create this kind of window of tranquility, relative tranquility, is what they're probably going to end up doing. But it's really just the final can kick, and that, in my estimation, that ultimately, if they are forced to create those kind of scenarios, that eventually confidence will begin to erode again, and it's not going to buy any time that's significant in terms of fixing the problem, because we're still talking about creating more debt to fix a debt problem. It's just that the debt's coming from a different place. Instead of getting vendor financing from the ECB, you have the Greeks issuing more bonds that are denominated in euros and also doing a parallel script. And that doesn't fix anything. It just buys time. So we're at the end of the year, we're going to probably all, if my assumptions and analysis prove correct, we'll be right back where we started from, no later than fourth quarter, beginning of fourth quarter at that. And ultimately 2016, I think we're going to see a Brexit.
And that's interesting, Eric. Some of those thoughts you were talking about a couple of moments ago is that somewhat substantiates a couple of thoughts I had this week upon seeing that report that the European Union differentiates, or the ECB, I should say, differentiates each nation's euros, in meaning that the Greek central bank prints euros for Greece, and they start with a certain prefix number, which is differentiated from Italy's euros and Spain's euros and Germany's euros. So, and when I saw that article, the first thought that passed through my head was, I wonder whether they are considering, technically it would then be feasible that you could declare Greece's euros are not going to be accepted in the rest of the European Union.
Yeah, I think that's possible, but it's not likely, because that ends up creating the same scenario of stimulating contagion fears. Because if one European nation can be treated that way, then Spain and Italy will once again look at it and say that their situation is the same as Greece, and that ultimately they could be second-class European citizens, so to speak, as well. But the issuance of debt that's denominated in euros but issued by the Greek central bank is not fitting into that quite the same way. And we had the precedent of Ireland back in 2011. So I think that the idea about having some kind of liquidity generated by Greece but still being within the Eurozone is probably more likely. It is interesting, though. We certainly have seen over the last 4 years or so, even average Europeans looking at Euro bank notes and seeing the symbol for a German-issued Euro currency and having preference for that, and holding those as opposed to euros issued on any other currency or any other nation. So there's definitely something to be said about that theory, but ultimately I think the more important probable outcome is going to focus more on the debt issuance and new bonds as opposed to something that happens with physical currency.
Well, we've been discussing Greece. One other question for you, Eric, on Greece. What is your thoughts on the potential implications if we did see a bail-in of Greek banks and Greek citizens, if we saw a Cypriot-style bail-in? What do you think the implications would be on the rest of Europeans looking at precious metals, physical gold, as a safe haven for their assets? Do you think a decent percent, say 20-30% of Europeans, that would be their wake-up call, or will they need something bigger than that to wake up?
at the margin, will definitely create more demand. It's kind of hard to estimate how much more, but I think that it would wake up, a lot more people, and maybe 10% of the population outside of Greece is a reasonable expectation. And we've already seen that there's been a lot more demand for physical gold and silver, and there's even been periods where it's been difficult to obtain retail products, particularly in Germany, which is pretty interesting that it's in Germany that we hear these reports out of, more so than, say, Spain. But it ultimately also will create more demand for stock market assets. I mean, not so much in the last month, but if you look further back in time this year, it's been a huge move in the DAX, and that clearly has been some form of safe haven buying by investors who believe that if they just buy the German company blue chips in the form of the DAX, that they will have some ability to transition to the other side of whatever carnage may happen when Greece endgame unfolds. So we still have this phenomenon where a lot of people in the conventional finance world consider gold a barbarous relic, and they're looking to the paper assets of claims against future earnings of blue chip companies that operate primarily in Germany as being the choice safe haven to dive into. And ultimately, I think the more interesting phenomenon that will grow out of the question you posit is that, if we have a lot of credit turmoil that spreads across the world as a result of a technical default being declared on Greece and the end game beginning to be defined and visible at the tail end of this month and going into July, that should create more turmoil in the credit market, which in turn should create more turmoil in the equities market, and that will be probably a powerful driver for gold and silver. So it's kind of like a different chain of events, but I suspect that this latter scenario is going to be what ends up creating more demand for gold and silver, because people will recognize that, oh, holy crap, the equity markets are highly valued anyway. We're still in a position where interest rates are being they're going up, but we've lived in a world where we not too long ago reached 400-year lows on the credit market rates, particularly for the long end of government bonds, and that is where there's too much risk, and therefore we need to begin to diversify. Gold and silver are still attractive because they haven't moved up much off of the lows. And I should also say too that when it comes to this whole is the Fed going to tighten stuff, to some extent the markets have actually already priced in a 25 basis point move with the Fed, because the long end and the short end of interest rates in the United States have already moved up. So some of the debate about these dynamics with the Fed tightening creating the ultimate trigger that creates a shit hit the fan scenario is a little bit over the top, in my opinion. I think that it's going to take more time for that kind of scenario to unfold, but I still, like I said in previous shows that we did last week with SGT and our own SD weekly metals and markets wrap, I think we have the scenario where we're going to see a pretty big stock market correction later this year tied to the whole quote-unquote normalization effort of the Fed and the interest rates. So even though Yellen temporarily pushed back expectations for the near term on when normalization starts, they're going to come back and do the job-owning game again, because they are stuck, and part of the song and dance that they do involves trying to regain their credibility. So I believe they will, in fact, do one interest rate hike, and that once that happens, and maybe it's September, it's hard to say, but once that happens and the economy's numbers fail to deliver the hope trade that is built into expectations right now, because, the first half sucked. The economic reports we're getting out of the United States is horrible. And now everyone's saying, but last year we bounced back and numbers didn't look so bad in the second half, and everyone's thinking that's going to repeat this time around, and frankly I don't think it's going to happen. And all of a sudden when we get to September, and if the Fed raises rates, and that's set against the backdrop of the economy actually looking bad on an ongoing basis, we're going to have a scenario where people are going to start questioning the credit markets and the stock markets, and we'll probably have a big correction in the September, October area in the equities market.
All right, well, before we wrap up the show, we'll give listeners a quick update on the physical markets here in the U.S. Strong demand, particularly in silver, has continued this week. I mean, Silver Eagle sales have pretty much doubled month over month here in the U.S. In May, sales were down to about 2 million ounces. We're on pace for, I think, 4.1 or 4.2 million ounces of Silver Eagles here in June, which would be the second biggest number of the year after January's 5.5 million. Year-to-date sales are over 19.5 million, so again, pretty much on pace for those same record highs we've seen the last couple of years in Silver Eagles. Availability is still decent, so it remains an excellent time for investors to acquire metals. And the one interesting bit of information that I'll share with the listeners here, I won't name any specific names, but there's been a lot of industry chatter this week. One of the authorized dealers and distributors has supposedly, there's a lot of chatter that they've made the decision that they're going to go retail, which should shake up the market quite a bit. It'll be pretty interesting to see how that plays out with allocations and supplies from a lot of the retailers that typically have been purchasing from this dealer likely won't be able to anymore, at least for certain products, because they'll reserve them for their own retail customers. Like, for example, AP Mex, they're an authorized dealer, but they don't typically sell very many, if any, of, say, their Silver Eagles, because they use them all for their retail customers, and they actually go out to some of the other authorized dealers to purchase more when they need them. So there's nothing official yet, and I won't name who it is, but there's been a lot of industry chatter, and certainly be interesting over the next 12 to 18 months to see. I personally think it's only going to be better for the average retail investor. The more, like any market that's not socialized, the more competitors you have, prices come down typically, and quality across the whole industry goes up. So certainly, in my opinion, a positive sign for the market and investors in precious metals. So we'll keep our eyes on that over the next few months.
If you were to speculate as to what were the motivations for this prime dealer shift, what would you think they were? And also, as a related question, do you think that the U.S. Mint would look at their relationships with their prime dealers differently as a result of this change?
To answer the second half of the question first, I don't believe the U.S. Mint will view them any differently. There are a couple of the dealers already that do that same type of thing. They're authorized distributors, but they also sell to the retail public. The majority do not, but there are a couple, and some of them are actually smaller ones. And the U.S. Mint really doesn't treat them any differently. So, no, I don't view that the United States Mint will treat them any differently. When coins are tight and they allocate coins, they allocate coins. It doesn't matter who you're selling them to. So I don't think the U.S. Mint's going to view them any differently. It's more of a shakeup within the industry. A lot of people who have been buying coins from them for a while are not very happy about it, because rather than being their supplier, they're now becoming their competitor, and so they're not very happy about it. So it'll be interesting to see how things shake up. And as far as the first half of the question, I'm probably not at liberty to speak too much to it, because I have a bit more information that I really can't disclose. I do have a decent idea of why they made that decision, at least an opinion on it, but unfortunately can't speak to that currently.
Well, we'll waterboard you after the show.
Sounds good. All right. Well, so as we close the show this week here, definitely encouraging that gold has reclaimed that 1,200 level and has made a weekly close above it, not even a daily close here this week. So we've got 2 consecutive daily closes and a weekly close in gold back above 1,200. And it'd certainly be nice to see gold mount a challenge on 1,230 next week. And it'd be nice to next week's show when we're closing up with John Embry that we can talk to him about how gold's closing above 1,230 for the week, Eric.
That would indeed be nice.
All right, so we'll wrap up this week's show there. For the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.